Brought to you by IOCO, Africa's leading integrated technology services company. It's time for Tech Talk. A shift is underway in South Africa's ride-hailing market. InDrive says its drivers are now earning 14,000 to 20,000 Rand a month thanks to a flexible pricing model and lower commission. With rising employment and growing interest in the gig work economy, or rather in the gig economy, is InDrive's model catching on fast? Business Day's Mudiwa Gavaza joins us with more detail. Mudiwa, thanks so much for your time this afternoon. And let's start with the fee structure, that model, and how it compares, InDrive's one compares to its competitors like Bolt and Uber.
So in essence, the fight that's being had here, if we're going to call it a fight, is a business model fight just around the relationship between the platform, drivers, and riders, right? So in the case of Uber and Bolt, which most people know because they're the two biggest in the market, you're using algorithms that determine the pricing. It's based on distance, it's based on how long the ride is going to take to complete. It's based on demand in the area. Is it a peak time? Is it an off-peak time? All of those factors feed into the algorithm, and when you request a ride, it's able to give you an estimate, and then you take that you take that on, right? So that's the model that Uber and Bolt both use. Though Bolt argues that the way that they calculate tends to be cheaper than what Uber does. I like that look because all of us as consumers have had these experiences, and especially with surge pricing, in areas where there's high demand, peak traffic, etc. You have surge pricing, which is a feature of both, Uber and Bolt, especially on Uber. The difference is that InDrive uses what's called a bid and accept system, right? It's literally a negotiation that's happening between the driver and the rider, that's the consumer, and you have InDrive in the middle, being the platform that this negotiating is happening on. So you request a ride, and you as the consumer can actually say how much you're willing to spend on the ride. The driver can choose to accept or decline, and then you can actually have a small back and forth, and then you can then take yourselves forward. So that's the key difference between the two. And as a result of that difference, InDrive actually takes on a smaller commission on each trip as compared to what Uber and Bolt do.
Is that model sustainable, Mudiwa, considering that consumers might not agree with the driver, or does the driver constantly get the price they want?
Interestingly, I was engaging with someone recently who drives for InDrive, but not in South Africa. But the model is the same. And what they were describing to me is the fact that because the way that InDrive is sort of positioning themselves is that we're better for drivers than the competing platforms. But when you talk to someone like this, they actually say the platform is better for consumers as opposed to riders, because in the market you have people that are going to be willing to take on certain fees that are much lower than everything else that's happening in the market. So the biggest risk there is that you might have that race to the bottom, where in certain instances it becomes unsustainable for drivers to take on some of these trips, and especially if you consider the expenses that go into either owning a vehicle, the maintenance of vehicles, or the most direct expense that people know is fuel, right? So depending on which way you look at it, InDrive is looking at themselves as saying we are driver focused, or rather they're saying we're better for the driver than the competing platforms. But when you talk to people in the ecosystem, they then say actually it's the consumer that's actually winning at the end of the day.
So there is potential to the upside when it comes to earnings, but I guess that hasn't been proven when it comes to the drivers themselves.
Basically, the argument is from a platform point of view, right? As a driver, you're going to keep more of your money.
Okay.
Using InDrive because they're doing a 10% commission compared to the 20 to 30% that is used by Uber and Bolt. However, the question is, what are you, or how much?
How much?
How much is the gross amount?
Yeah.
You know, versus and the net amount that the driver actually gets to keep at the end of the day, because you could actually have an argument around if you have a higher algorithmically based fee that comes out and you take out, let's call it on the upper end, you take out the 30% on the same trip, it's possible that a driver might actually be keeping more money,
yeah,
right, using a 30% commission as opposed to a 10% commission, because it depends on how much has actually been agreed on between the driver and the rider.
I wonder how many drivers then actually use InDrive and the market share it has in that ecosystem.
So in 2023, InDrive told us that they had 45,000 drivers at the time.
Yeah.
So, you know, based on their growth rate that they have released, you know, as part of part of this reporting, our estimate is that if everything is held, you know, constant from 2023, then they would be sitting at roughly 67,500 drivers today.
Yeah.
But that's, unfortunately, they don't tell us, right? We're sort of guesstimating.
How does that compare to the likes of Uber and Bolt, if we have those numbers? Do you, by any chance?
We do. I was actually looking at it just now, you know, to say that on the Uber side, I believe it's 100,000 drivers. Yes, 100,000 drivers on the Uber side, and 2 million passengers that they're commanding on the Uber side. So, and the other thing we also need to consider is the fact that in many instances, someone who's on Uber
is
also on Bolt. Yeah.
But are they on InDrive? That's the question.
That's the question, yeah.
Okay, with that being said, right, we've had concerns around safety within that industry, Bolt really coming under fire. And I think when InDrive was introduced at the beginning, they were also, you know, facing similar concerns. How are they going about addressing that? And particularly because they are also looking at serving the underserved communities, which could also be communities or areas that are considered dangerous to have high crime rates?
So, once again, a very interesting point, you know, because what this lower pricing does is that it brings in a lot more people, right, into the net, right, and a lot more areas, you know, into the net. To your point, almost all the platforms have similar features in place, panic buttons. They have panic buttons in place, you know, the ability for your ride to be followed, you know, all of that stuff. That's one aspect. And then the other aspect is the fact that the incidents that we're talking about that are happening on ride-hailing platforms, the infamous ones, you know, the trash things that are being done, right? A lot of that stuff is being done at a car level.
Yeah.
Right. So if you have generally a similar pool of people that are operating across different platforms, right, then it means all the platforms are in essence opening themselves up to similar risk.
Fair.
If what I'm saying is making sense, you can have your safety measures in place and all of that, but we have seen time and time again that if a person is going to veer off, right, and do something terrible, they're going to do something terrible, despite some of the safeguards, and that's the unfortunate, you know, reality that does exist. I remember a couple of months ago, I did, you know, come here talking to you about one of the businesses that was recently funded that helps to, you know, give,
Aurora, was it?
Yes, Aura.
Aura.
You know, that helps to give, you know, emergency support for some of the ride-hailing platforms. So a lot of the measures are in place, but the realities are still stark.
Always room for risk, right? All right, let's talk about the regulatory environment. There's been a move to somewhat formalize the industry with the introduction of the Economic Regulation of Transport Act. That, however, not really working in the advantage of drivers here. We're talking about drivers that are even earning less than the minimum wage. We've seen strikes taking place. Should there be some form of, standardization within the industry, especially when it comes to earnings? I think even yesterday there was an Uber strike.
So on this particular point, it just depends on, from a policy point of view, what are the policy makers prioritizing?
Yeah.
Right. And I say that because this is bigger than just a e-hailing discussion. This is a gig economy discussion. And more we see businesses moving towards the gig economy and also moving towards contract work, because in essence, it's more or less the same thing. In fact, in the technology sector, when you look at trends in places like the United States, etc., they actually show that companies like Google have over 40% of their staff, being contract workers, right?
Yeah.
So it almost shows you the fact that what we consider permanent employment might not be so permanent, down the line. So a bigger discussion needs to be had about how you guarantee or you protect people in the gig economy, people that are doing contract work. Places like India, for example, have protection specifically around gig economy workers. And what they're prioritizing is, yes, we can talk about the earnings, but let's make sure that we have things like, leave. We have things like, some type of assistance around, medical, those types of things. So from a country point of view, South African policymakers would need to decide, right, what are we prioritizing? A lot of the time we talk about earnings, and that's a whole discussion and where a lot of the focus tends to be, but there are also other quality of life things that are inside there, leave, protections around medical, what happens in the case that someone is injured, all of those things that fall under, what is it, the basic conditions of employment,
yes,
right? How much of that can actually be netted in, for gig economy work. So I think there's a big discussion that does need to be, had around that. Earnings will continue to be a big issue. I mean, if you just look at some of the disparities, right now we can say on average you're looking at 15 to 20,000 as an e-hailing driver, because the estimates on Uber is that you're looking at up to 20,000 gross,
yes,
but after taking into account costs, the average driver is taking home 12 to 15,000 rand.
And how long would they be driving, getting that much?
Well, there are many estimates, but I believe it's between 10 and 14 hours a day, from one of the numbers that, sets of numbers that I was able to see. So it's not an easy job. And fortunately and unfortunately, looking at employment and how it is in South Africa, when it comes to gig economy, these types of e-hailing, the delivery sites, driving has become probably one of the biggest employers from a gig economy point of view. So whatever happens in this sector is likely going to shape how we think about e-hailing and the gig economy going forward.
One thing I have to say is that the hustle culture is really killing us, because everyone has 2 to 3 jobs and all contract work. Doesn't seem as sustainable, but we will see how it develops. Mudiwa, thanks so much for your time and coming through to studio. That was Business Days, Mudiwa Gavaza. Brought to you by Ayoko, Africa's leading integrated technology services company.